Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching Easynomics. On today's episode, we are joined by noted economist Sajjid Z, Chinoy, the Managing Director and Chief India Economist at JP Morgan. Welcome to the show. Sajjid, clearly a very interesting time to be discussing the complexities of global trade post the Liberation Day announcement of President Donald Trump. You've written a very wonderful article about that, and I want to keep the conversation focused on, as you put it, India in Trade War 2.0. One of our recent issues of Business Today had also led with the headline India's China moment, and I want to begin by really getting you to explain to our viewers what is your reading of the situation that India finds itself in, given the current state of our trade talks with the United States and what seems to be happening globally within the 90-day pause.
Thank you, Siddharth. It's great to be here. So I think of this as being always there being kind of opportunities within a crisis. And I think for what we're seeing from the broader global standpoint here is nothing short of, transformational. In the sense that we're seeing supply chains are going to be jigged like they haven't been in 20 years, 30 years. Now, let's just step back and address the bigger picture. The global economy goes into this trade turmoil on relatively sound footing, despite all of the noise around the US economy contracting in the first quarter. That was in our minds a technical contraction, had to do with strong imports. But the rest of the global economy actually has been doing quite well in the first quarter. It's the same resilience that we've seen through much of 24 and 23, arguably helped by some front loading of exports. But I think we should not underestimate what both the near-term hit to global growth is going to be, as well as the medium-term opportunity that India will find itself in. And I think both risk being underestimated. So maybe we'll discuss both in turn. Just to first lay down what the near-term pressures are going to be, there's a lot of expectation here that the US will sign bilateral deals with many countries, the large trading partners. I think India is in very good footing here. I think we should be among the first countries to get over the line, hopefully. But I'm much less certain that other Southeast Asian economies will be in a position to conclude a trade deal with the US. And I think therein lies India's opportunity. But before we come to that, just to point out that even if the US were to succeed in many of these trade negotiations, we're still looking at a universal tariff of 10%. We're still looking at sectoral tariffs on aluminum, on steel, on autos. And the belief is in the best case scenario, there's a 60% tariff on China, right? If there's a de-escalation. In that environment, the effective tariff in the US is something close to 16%, which should not be taken lightly. The tariff that the US had was 2.5% last year. This is a six-fold increase and then some on imports into the US. And our sense is this sets up the US for a recession in the second half of 2024, both because a tariff increase of this size will really squeeze purchasing power. It will push up inflation in the US. Yes, there's an offset because crude prices have fallen very sharply, and that should give some purchasing power space. But I think the tariff effect is very large. And the second is we're living in times of unprecedented uncertainty. The fact is these deals are going to take several months or quarters to be completed. Until that is done, there's most likely going to be some kind of investment freeze around the world, because who's going to want to invest when you don't know what the rules of the game are? So I think in the near term, we should brace ourselves in India for the fact that you could see a pretty sharp slowing of global growth. There's a heightened risk of a US recession, and that will have a backflow onto Indian exports and Indian investment as well. The good news is crude prices are in the low 60s, and that will provide some cushioning impact. So in the very near term, we'll have to be careful about what the implications on India's growth is.
That's a nice summation. Sajjid, a couple of points that arise in follow-up to what you said. The first, are you factoring in a possible extension of the 90-day pause as the US winds through these torturous negotiations? And I must tell our viewers that you've called it a Brexit-like moment for the world's largest economy, and also a spaghetti bowl of new tariffs that will emerge. So Is there a possibility of an extension of this pause?
I think it's very likely that this will be an extension. I think the US authorities have indicated that they lack the absorptive capacity to conclude 20, 25, 30 trade deals. These things normally take quarters and years in a 3-month period. I mean, we're over a month after Liberation Day, and we haven't seen even one deal being successfully concluded. The expectation is India is the closest, right? And so my sense is that at the end of 3 months, what the US authorities have said, no less than Secretary Bessent, that those countries negotiating in good faith will be given a further extension. Now, that's good news because it gives countries more time to hammer out an agreement, but it means in the near term that the uncertainty around US policy, trade policy, tariffs will continue much beyond 3 months. It could well be 2, 3, 4 quarters. And I think just not to miss the forest for the trees here, while there could be some relief that some trade deals get concluded, we're basically dismantling a global trade system that for all of its warts and all of its distributional concerns, which are valid and warranted, serve the globe very well. We've seen unprecedented rates of growth and development and job creation in emerging markets because you had this rules-based trade system which created certainty on which investment and exports were based. If all of that gets dismantled and you're going to have 50 different tariff rates for different countries, you are going to get this very Byzantine spaghetti bowl, lots of trade destruction, some trade creation, lots of trade diversion. And that, at least in the near term, doesn't bode well, for global growth and global welfare. But within that larger chaos, there will be opportunities, and I'm hoping India can capitalize on those opportunities.
We'll turn the conversation to India, but one more quick follow-up. Should we all assume that a decoupling between the United States and China is a given? Because you said the best case tariff scenario for China was 60% if everything goes well, and that's a very big if. And you also very correctly pointed out to the 16% kind of becoming the threshold above which things may happen. So is a decoupling certain in your view, or do you see some signs of a rapprochement?
I think, currently what we have with these tariff rates at 145% and 125% is for all practical purposes an embargo, right? There's going to be virtually no trade between the two largest economies, and the collateral damage, especially to Asia, a lot of small Asian economies, India may be an exception because we're not that closely linked with the Chinese supply chain. But a lot of other small Asian economies, the Taiwans of this world, the Vietnams and Cambodias and ASEAN economies, have a lot of their exports directed to China, and a lot of that is then redirected to the US. Yes. So when China-US trade virtually halts, there's a large collateral damage that's felt on the rest of Asia, on Mexico, and many emerging markets get caught in between. Now, the hope is we'll walk back from the precipice, but walk back to what? And if you're going to be looking at 60% tariffs, that is still a very large wedge. It is going to mean that trade flows between the two largest economies are going to slow. Now, to be fair, some of this process began after the first trade war in 2018. And what China very cleverly did was it redirected some of its exports to the rest of the world. So China's share of US exports came down, but China's share of global exports actually went up. So what China, I think, will endeavor to do is it'll diversify its exports away from the US. This is a bit of a threat for the rest of emerging markets, for Asian economies, and for India. Because what this means is, especially if Chinese transshipment, exports of China going through Vietnam, Cambodia, Mexico to the US gets stopped. And, for all practical purposes, the US administration seems very hawkish and determined to stop the transshipment. Then a lot of that excess capacity that's sitting in China risks flowing into third markets. It risks flowing into Asia. It risks flowing into India. Let's not forget that India's bilateral trade deficit with China and Hong Kong has been rising secularly. And we're not the only country. All of Asia is suffering from this. And the deficit this year is going to be close to 3% of GDP. So there's going to be two impacts on the rest of the world that are worrying. One is to the extent that you export to China, which then gets re-exported to the US, those avenues close down for Asian economies. And secondly, it means a lot of the Chinese excess capacity gets redirected to parts of Asia, and that's going to hurt manufacturing competitiveness in many of these economies and is a real risk for India, which we need to watch out for.
Therefore, this scenario that you outline, and completely in the realm of possibility, despite us not being so welcoming viewers to Chinese investment after the Galwan incident, the numbers and the bilateral trade deficit of 3% that we are likely to see just tells you about the reality on the ground. Therefore, Sajjid, where do we really stand? Are we in a position to effectively replace China in the global value chain? Maybe, particularly in sectors like electronics, for example, or others. And I must remind our viewers about the latest headlines on account of Apple, which is pretty much said that all the phones that it sells to its US consumers will be made in India.
There's a huge opportunity for India, right? And this is, I would say, it's a generational chance of export-led growth. It's a generational chance of getting more integrated into global value chains. Why do I say that? Because there's a very important distinction between the first trade war that happened in 2018 and this trade war as far as India is concerned. The first trade war, to start with, the tariffs on China were more modest. It went from 3% to 20%. As we're saying now, 20 will go to 60. But there's a more important distinction. When tariffs went up on China, and there was a focus on China plus one, which happened both in the first trade war and then in the pandemic, right? The large beneficiaries of that were Southeast Asian economies. It was Vietnam, right? It was Malaysia, it was Thailand. Because they were very integrated with the Chinese supply chain, right? They were the beneficiaries of China plus one. Now, this time around, they're going to be painted largely with the same brush as China is, because the US is very fearful that if it puts high tariffs on China at 60%, but the tariffs on the rest of Asia, Southeast Asia and Vietnam and Malaysia and Cambodia is 10%, then what's going to happen is a similar process to the first trade war, where China will get around this by transshipping to third countries, and it'll defeat the whole point of the US tariffs. So my suspicion is the US is going to take a very hawkish view on Southeast Asia. And that will mean that our sense is that a lot of these negotiations with Southeast Asia will involve these countries putting on tariffs on China to prevent the transshipment. Now, I'm not sure whether these countries are going to be in a position to put on tariffs on China because A, they're in the backyard, B, they've got very strong trading relationships with China. A lot of Chinese imports come through these countries and then value is added and shipped on. And C, these countries export a lot of stuff for Chinese domestic demand. D, there's a lot of FDI that flows from China into these economies. Given these strong trade and investment linkages, it's very unlikely that a small open economy in Asia is going to turn its back on China and put a large tariff on like what the US is insisting. In fact, Xi Jinping was in the region 2 weeks ago. He toured Vietnam, Cambodia, Malaysia, and all of these economies stood up and said, we're going to side with China. We don't want to get onto ugly tariffs. So what that means is the likelihood of Southeast Asia striking bilateral deals with the US is lower because rules of origin will bind more. And so there's a real possibility here that if Chinese tariffs are at 60%, Southeast Asia will not be at 10%. It'll be some fraction higher than that because it's been thought of as in the same bucket as China. Now, that's where India's opportunity arises, because when multinational firms recognize that the rules of the game have changed, many of these economies that benefited from FDI will now be facing higher tariffs. They'll be looking for more geographical diversification. They'll be looking for more hedges. And India will seem very attractive for two reasons, or three reasons. One is if we can, close that bilateral deal with the US, then, we'll have a 10% tariff, hopefully less. B, we're not so linked to the Chinese supply chain, so there is a hedge. And C, India has a large market. Therefore, I think I'm not surprised by what Apple has done, that multinational companies will look at India as being the hedge in the region to China and Southeast Asia. And I think that's where India's real potential and prospects lie. So there are very powerful push factors that's going to push investment our way, but we need to complement and close the deal by focusing on pull factors to bring that investment to us.
That's a very important point, and that's exactly my next question. What do we therefore need to do? Because we had a similar kind of argument, China plus one post-COVID. Did we avail of the entire opportunity? Perhaps not. Did some moves get made? Yes. But given the size of this opportunity, what do we need to do to actually benefit from this?
So that's exactly right. I think the push factors this time are perhaps larger than what we saw in COVID, but this doesn't undermine the importance of pull factors. I would think there are at least three sets of things we need to do. One is, if you want to attract large multinational companies and integrate into global value chains, you have to give those companies the visibility of relatively frictionless export markets, right? And so concluding a deal with the US where we get preferential trade access to the US, I would say is a necessary condition, but by itself it may not be a sufficient condition. So it's equally important that we conclude trade deals with the UK and with the EU, and think at some point about a mega regional trade deal or a trade deal with Southeast Asia, right? Then you're giving exporters the visibility that producing out of India, you've got relatively frictionless markets in the US, in Europe, in the UK, and in a world of global value chains, goods go back and forth across borders multiple times. So we need to get more integrated with Asia, because some of the value is created there, some of the value we create in India, and you want frictionless trade. So I think the first thing is to give visibility of markets. The second is, and I think the government's made a very encouraging start in recent budgets, to reduce import tariffs. Remember, in a world of global value chains, an import tariff is the same thing as an export tax, right? So if you want to pursue the export model, we'll have to continue bringing import tariffs down. We've seen encouraging progress in this year's budget. We need to continue down that path. And this is a fine balancing act, because there'll be pressure from industry to put on tariffs on Chinese imports to reduce dumping. So we have to manage that artfully, that in certain cases where it's compelling, you may need some protection, but otherwise you don't want to be in a situation where import tariffs are going up and that's hurting your ability to become more competitive on the export front. And I think the last bucket of things is something we've spoken about before. We need to continue with reforms that improve the ease of doing business. If you look at India's relative comparative advantage, right, compared to Vietnam and China, we do quite well in labor-intensive sectors. So I know there's a lot of talk about low-tech and mid-tech and Apple iPhones, which is encouraging, but there's also a lot of potential, I would argue, in areas like leather and textile, because our revealed comparative advantage is quite high, but we're under-penetrated in the US market. So if there are higher tariffs on China and Vietnam, India should be a natural beneficiary of that process. Now, what we need to do is domestic reforms that give ourselves the best chance. I think it'll be good to implement the 4 labor codes, because if you want, to make the best of these labor-intensive sectors, you want firms to grow in size, because you need that scale to compete in global markets. So having flexibility in labor markets is important. We've got the 4 labor codes. I think it'll be important to implement that and continue with improving labor market flexibility. That I think the economic survey correctly argued powerfully for deregulation. The Prime Minister has said we need a deregulation commission. This would be a good time to put together a deregulation commission to ease business. We've spoken about a bilateral investment treaty, a new model to make it easier to get bilateral investment. We should, fast track an investment treaty. And if we have to give public sector incentives, it should be to the labor intensive sectors where job creation is high. So I think there's a lot we can do domestically in addition to the export and import fronts that I spoke about earlier. This needs to be a full court press.
Absolutely. And allow me to just add that perhaps measures that can help reduce judicial uncertainty, because there's a lot of chatter after a Supreme Court judgment which basically overturns a 4-year-old insolvency matter, and just that time taken, without commenting on the merits of the case for or against, but just the time taken to arrive at a decision has come as a shock and perhaps a big blow to the insolvency process. I want to follow your point up with a reference to the other trade deals that India has been pursuing. The United Kingdom trade deal a year and a half ago, we thought it was almost done. We now see reports that again there seems to be a last minute hitch. What is the downside risk, Sajjid, in your view, of the other trade deals not panning out, in a sort of early harvest approach? Does that pose a significant risk to this scenario?
No, I think that as you alluded to in your previous comments, that this is a world that's full of uncertainty, heightened levels of uncertainty. And for India to stand out in this environment, we have to be in the opposite. We have to provide a beacon of, stability, consistency, transparency, reform. And I think, therefore, it's important to show that the India-US trade deal is not a one-off. It's not something that we've just done, to mitigate this particular situation. It's part of a broader export-led approach. And I think, to the government's credit, in the last two budgets, both spoke about the need for export-led growth. I keep repeating the fact that only 13 economies in the world since the Second World War have grown at 7% or more for 20 years at a stretch. India needs to emulate that. All those 13 economies had one thing in common. They had high levels of global engagement. So this is no time for export pessimism. I know there are a lot of export pessimists there. When India's manufacturing share globally is less than 2%, what we have to focus is on doubling that share. It doesn't matter how large, how much the pie grows or shrinks. So I think we need to give the impression that we're very focused on exports. We want to create an ecosystem that's going to promote export-led growth. And that's why it's important that we complement the US deal with the UK and Euro area deal, because that will send a clear message to multinational companies, investors, that India means business, that they want to push on the export angle and will provide the ecosystem that's required for these firms to flourish in India.
Sajjid, a couple of questions before we end today's conversation. I just want you to comment about this debate that happens sometimes happens behind closed doors, which is domestic industry saying that, listen, we've also been working on Make in India. We've served the domestic consumer. We've contributed to tax revenues, and we need some amount of protection. How does our policy balance this in the current scenario?
My own sense, Siddharth, is that the bar for providing protection should be very high, because I think if you look at India's history over the last 60 or 70 years, very often we've come across this argument of an infant industry protection that just protect us for a few years, and when the industry matures, you can release that. And we know from a political economy standpoint that rarely happens. Once the protection is put in place, it's very rarely withdrawn. And what that does is it breeds relatively uncompetitive firms and sectors. So I think the lesson of the last 20 years is very clear, that when you compete with the world and you reach a size and scale where you're competing with the world, you're also becoming far more efficient and far more productive and far more competitive, right? And I think that's the model we should pursue here, that we need to make in India for the rest of the world, right? And therefore, do what's in the interest of firms to grow to that size where they can compete with their peers in the rest of the world. And therefore, I'm personally very skeptical that, we need protectionism. As I said, every economy that has succeeded over long periods of time has relied on the export engine.
Absolutely. One final question, and this is your sense about the domestic economy moving away from our trade-related conversation, and your reading of how inflation is likely to pan out in the medium term, and the growth impetus, because you at the very top of this conversation also spoke about the risks that are likely from a US slowdown stroke recession and what it could mean for us. What is your own readings, Sajjid, of this?
I think the best news that we have in the near term is on how inflation is going to pan out. We've always had, low core inflation in the last couple of years because the economy still is living with slack. Food inflation was the real irritant for about 18 months when you had that El Nino period. And the really good news is that is behind us. We've had a very strong Kharif harvest. It seems like we're on track for a good Rabi harvest. Crude prices are down to the low 60s. All of this is going to be very disinflationary. And if you look at the Chinese excess capacity, that's going to be disinflationary in the entire region. So I think the one thing India can take, a huge sigh of relief is over the next few months, barring fresh shocks, we're looking at inflation being very close to the 4% target, right? And what that's going to do, along with the global uncertainty, is free the central bank to pursue monetary easing, to insulate, to kind of buy insurance against a growth shock. And we've seen the RBI move decisively. They've moved on rates, they've moved on liquidity, they've changed their stance, they've changed their approach on the exchange rate. So I think all of that is much needed, much warranted, and monetary policy is going to have significant degrees of freedom in the coming months, in my view. But we need to be careful here because even though lower inflation hopefully will boost consumption, lower oil prices should boost consumption, good agriculture harvest should boost rural demand, there are growth headwinds to the Indian economy, like there are to the rest of the world, that we need to be cognizant of. One is the export slowdown. Even if we sign a deal with the US, remember, if the global economy slows and the US goes into recession, India's exports to GDP are 22%. All of that will face some hit. We're already seeing some early signs of both manufacturing and service exports slowing the last couple of months. But for me, the bigger focus area will be on investment, because we've all been waiting for a private investment cycle. Public investment, it has kind of peaked. We need private capex to pick up. And in a world with so much heightened uncertainty, trade uncertainty, policy uncertainty, China uncertainty, it's understandable why Indian private sector may wait a little bit more before they choose to invest, because this uncertainty could take several quarters. So that's what I worry about, that in the near term, you could get exports coming under some pressure and incentives for private sector to delay investment, which is why it's important that we use the instruments we have. One is monetary policy, and B, on fiscal policy, I would say it's really important that we continue with the public investment thrust, that there's no let up on that front, so that fiscal and monetary buys us some protection in the near term, until we see more clarity, more certainty, hopefully a US-India trade deal, and some of this FDI will fructify, and you'll get some private investment pick up, in the coming years.
Absolutely. Sajjid, thank you very much for making the viewer aware of the opportunity and the challenges. And like you wrote, perhaps this is the time for more openness, consistency, and reform, which can really make this India's moment in a world that is awash with uncertainty. Thank you very much for your time once again. With that, it's a wrap on this episode of Easynomics, viewers. We'll come back with more discussions on what the global economy is likely to undergo as Trump's tariffs continue and clarity is still a few weeks and months away. If you've been, thank you very much for watching.